Hello everyone, my name is Vivek. Today in this video we are going to discuss on the fractional reserve banking. Basically this is a mechanism through which the money supply in the market is decided by the central bank of any country. So as you might be knowing that the central bank is responsible for printing the money. Now is it that the money which is printed by the central bank is equal to the money supply? The answer is no. Let's say M amount of money is printed by the central bank. That doesn't mean that all the market participants in the economy are going to have the same amount of money in total. The difference is created because of the fractional reserve banking. In fact, the fractional reserve banking leads to a situation where the money that is there with each and every participant, when added up, is more than the money that the central bank has infused in the banks. So let us understand how this fractional reserve banking actually works. Now let's say H amount of money was infused by the central bank in any bank, or let's say all the banks that are there in the economy. So H amount of money was infused. This initial amount that the central bank kept in the banks is known as the monetary base. Okay, this is the base amount. It is also denoted by M0 money. Now this is the initial amount that the central bank kept. Now let us see how this thing works. Let's say H amount of money was kept with the bank. Now the bank is allowed to lend money, but it can't lend all of it. You might be knowing that there are the cash reserve ratio requirement and statutory liquidity ratio requirements that are there. Means it, in simple words, the bank has to keep a portion of this amount as reserves so that it can meet the demand that are made every day. So for everyday demands and for everyday works, it has to keep some reserve. So let's say the total rate of the net demand and time liabilities that is required for the banks to keep as a reserve is R. That means R% of the total money that the bank has, it has to keep it as a reserve. So out of H money that the bank has got, it will keep R%, which is HR by 100. This is the reserve that the bank will keep, and the remaining it can lend. So it can lend how much amount? It can lend H minus HR by 100, which works out to be H1 minus R by 100, right? So this is the amount of money. This one is the amount of money that the bank is allowed to lend. Now this lending will be done and some goods and services will be availed, and let's say this entire money again will come into the bank. What do I mean is that this amount was lended for a particular region. Now that person to whom, or the company to whom this money was lended, they are going to buy some goods or services, they are going to do something, and let's say that money will again come to the bank. So this money will again return to the bank, okay, because nobody is going to put the cash with them, so they are again going to deposit it in the bank. So again the bank is going to have H1 minus R upon 100 as the amount. Eventually out of this money also the bank has to keep reserve, so it will again keep R% of this amount. So R% of this amount will be HR1 minus R upon 100 upon 100. So this is the amount that the bank will keep, and the rest will be again available for lending purposes. So the amount that will be left is this minus this, so this works out to be H1 minus R upon 100 squared. Okay, this you can find out, and this is the amount now available with the bank to lend. Now again the bank will lend this, again some goods and services will be availed, and this amount will again return back in the banks. So the money now the bank has is H1 minus R upon 100 squared, and again it will keep the reserves of R%, so this works out to be 1 minus R by 100 squared upon 100. Now the money that the bank is left with is H1 minus R upon 100 cubed. So now you can see that where this is going, like it will keep on going like this. If you see the total picture, you can see that initially it was this amount, then the bank had this amount left, then the bank had this amount left. Okay, so this money that you are seeing, this money is actually the sum of this all money is equal to the money supply. Why? Because every market participant is believing that they have this amount of money with them. Let's say if some person was there who took this money for some purpose, then in the second stage some other person came, or a firm came, or an organization came, they believe that this amount is with them. So all this money that you are seeing is the amount that each and every participant has in the economy. So the sum of this number, the sum of the money that is there on this side, this is equal to the money supply in the market. So this will keep on continuing up to infinite time. We consider that this will keep on going infinity, up to infinity, right? So we are concerned more with this one, okay, because we are trying to find out the money supply. So what is going to be the money supply? It is going to be the sum of the money that the central bank infused initially, that is the monetary base, plus this series that you are seeing. This is a GP series, a geometric progression is going on, right? So we can write it that this goes up to infinity, h 1 minus r upon 100 power n. Okay, so n is here, so n, so it goes from n equal to 1 to infinity. So this is what is the total money supply. So let me write it here clearly. So money supply, ms, is equal to h plus h 1 minus r upon 100 power n, where n goes from 1 to infinity. Okay, so this comes out to be how much? This comes out to be, if you find out the sum, you will get that this is an infinite GP series, and for an infinite GP series, if you find out the sum for an infinite GP series, the result is equal to the sum of the series is equal to first term divided by 1 minus the common ratio. Okay, so let us write it here. So the first term here is h, okay, divided by 1 minus the common ratio is 1 minus r upon 100. So 1 minus 1 plus r upon 100. That means if I directly write it, I can write 0.01 r. Money supply is equal to h upon 0.01 r, where r is the total reserve rate that is required. So let's say if 10% of reserve is required, for example, let's say the central bank infused $1,000 into the banks, okay, $1,000, so h is equal to $1,000, and 10% is the rate that is required, total rate that is required as reserve. Okay, so if 10% is, so we can find out what is the money supply. So money supply in this case is equal to 1000 divided by 0.01 times 10. Okay, that means the money supply is going to be 10,000. Okay, so you can see the money supply is 10,000, whereas $10,000, whereas the money infused by the central bank is $1,000. And who is deciding all this? Who is deciding what will be the money supply? It is this R. So R is going to decide that what is going to be the money supply. That's why we say that if the reserve requirement is increased, the money supply goes down. You can clearly see from this equation now that, let's say if I had increased this to 20% instead of 10%. So 20% means now this would go to 20. Okay, so this will be 20 upon 100. Now this amount will be only 50,000. Okay, so only $50,000 are going to be in the economy as the money supply, and this is known as the fractional reserve banking, where a fraction of the money that is available with the bank is required to keep that as reserve, and the rest of the money is lended out. Okay, now what would have been the scenario if this R was not there? Like if the bank were allowed to supply all the money or the lend all the money that they are getting into the economy, well, in that case R would have turned to zero. If it had turned to zero, the money supply would have been infinite, which means an uncontrollable situation, which is not good for any economy. It is dangerous, because let's say if the banks are allowed to lend all the money that they are getting, then if let's say a lot of people come to withdraw their money and demand their money, the bank will not be able to serve all of those people, and eventually there will be a situation we call the bank run. Okay, it is known as the situation of bank run. Okay, that's why the banks are allowed to lend money, but not all of that. A portion of that is kept as reserve. This reserve can be kept with the bank itself and also with the central bank of that country. Now let us understand more. So one more thing, we saw that the money supply is equal to h upon 0.01 r. Now this 0.01 r is coming because we are taking r as a number. Okay, like let's say if I say r is equal to 10%. Okay, if I say r is equal to 10%, then it will be h upon r. Okay, this is something you need to understand, that it will be equal to h upon r. But if I only say that it is r percent, Okay, if I say that this is R percent, then that means that if I say 10%, that means R's value is only 10. Okay, so in that case this equation holds true, right? So if I take R as percentage, then the money supply in the economy will be equal to H upon R. Okay, this is going to be the equation. Now this money supply that you are seeing, this is known as M3 money, and we saw what is M0. M0 is equal to H, which is the reserve money, okay, or the monetary base. So you can see that what is the money multiplier. So the ratio between how much money supply is there in the economy and how much money the central bank infused in the economy is known as the money multiplier. So money multiplier is equal to M3 upon M0. Okay, this is known as money multiplier. So money multiplier simply means that how much money the central bank infused and how much money eventually is there in the economy. That's what is indicated by the money multiplier. So M3, we saw that M3 is H upon R, and what is the M0? That is the monetary base, it is H. So if you work this out, you will find that it is equal to 1 upon R. That means the money multiplier that is in the economy is 1 upon the reserve ratio that is required. So let's say if 10% is the reserve, 10% is the reserve requirement, that means this will be equal to 1 upon 10%. So 100 goes up, that means 10. That means whatever the money that is supplied in the economy, it will be 10 times. If central bank supplies let's say $1,000, then eventually the money supply that will be there in the economy at max will be $10,000. Okay, that's why these things are really important for the central bank to consider before printing money, because if too much money is printed by the central bank and these things are not cared of, then there will be too much money supply in the market, and eventually the inflation will go up, which is another catastrophe for the economy itself. So I hope I was able to make you clear about what is the fractional reserve banking and how does it work. Thank you very much for watching. See you next time.